traders at Access Bank expect the bond market to remain bearish due to the continuous rise in yields of short and long-dated Treasury bills and increased rate in overnight placements in the markets. Ebube Uneze, the Treasury Team Member at Access Bank, joins me now for more on the market this week. Thank you so much for your time today, Ebube. And let's look at what's driving sentiments in the market this week.
Thank you, Kenneth. So at the start of yesterday, we saw a market liquidity open at a credit balance of 593 billion naira, a significant increase from the previous day's levels. Despite this increase in market liquidity, we saw the money market rates increase significantly to close at 11.25 and 11.83 and 12.25% for the OPR and overnight rates, respectively. This increase in rates was largely fueled by the news which was received within the week of the central bank removing the cap in the maximum amount that banks can place with them. So there had been a cap of 2 billion naira prior to now, but the central bank has removed that cap. So we interpret this as a move by the central bank to return to orthodox monetary policy measures. On the back of this, earlier in the week, also on Wednesday, we saw the DMO float an auction of the Treasury bills where they sold a total of 108 billion naira in bills across the standard maturities. We saw stop rates across the 91-day, 182, and 364-day papers close at 5.99%, 9%, and 13%, which were significant increases in stop rates from the previous auctions. This move in both the money markets and the Treasury bills market had a reaction in the secondary market for both the bills and the bond market. So we've seen market participants reprise the bills. We've seen higher yields across all the securities. Currently, the recently issued bill, October bill, is trading at 12.5%, and the previously issued one of September is trading at 11.5%. In the bonds market also, we're also seeing a repricing across the curve. The short tenured bonds are trading at an average of 40 bips higher than where they were trading previously. The longest tenured maturity, which is the 2053 bond, traded as high as 17% yesterday, which is the highest we've seen till date.
Let me get to the issue of the FX now. And looking at the NAFEM market activity this week, we saw some appreciation on the parallel market today, but I'm trying to imagine how that activity has been at the NAFEM market this week.
All right, thank you, Kenneth. So at the NAFEX market yesterday, we saw the NAFEX depreciate by about 8 naira to close at 803 naira, whereas in the NAFEM, which is the Nigerian Autonomous Foreign Exchange Market, we saw rates also depreciate to close at 837 naira 3 kobo to a dollar. It's been reported in some news quarters about an appreciation of the greenback to the dollar in the parallel market. However, we attribute some of these sentiments to the recently announced pronouncement by the federal government of a $10 billion inflow expected from various sources, which is expected to impact the market in the coming weeks. It's expected that with the impact of this liquidity, we should see a significant decline in the exchange rate and an appreciation of the naira to the dollar.
But let's look at liquidity in the general market now and what your expectations are in the coming weeks. Any major maturities in the near future?
So for today, we're expecting FAC inflows of about 903 billion naira to impact the system. Also, on the 2032 bond, coupons of about 53 billion is expected to impact the system today. Despite these inflows into the system, we still expect money market rates to remain at elevated levels, largely driven by the removal of the cap in the maximum amount that can be placed by banks with the central bank.
All right, but looking at the bond space now, and I'd like you to speak to the yield curve activity and where investors are positioning in this period.
Yeah, so as I had earlier mentioned, we've seen a repricing across the yield curve So yields are slightly elevated as a result of this recent activity in the money markets and also the increased stop rates and the recently conducted Treasury bills auction. As a result of this, we are seeing higher yields across the curve. On the back of this, we expect that participants will continue to trade at these levels to take advantage of these new yields while also taking advantage of the improved liquidity in the system.
Yeah, but in the near term, how is that going to play out for secondary market rates then?
Yeah, in the near term, we still expect rates to remain at elevated levels, especially the primary driver of this is the removal of the cap by the central bank in the volume of trades that can be placed with the central bank in the SDF window. So we expect that this improvement in liquidity is going to significantly impact the activities in the secondary market. Rates will still remain at elevated levels.
All right, thank you so much for that breakdown there. Ebube Uneze there, the Treasury Team Member at Access Bank, talking about